I just had a conversation with a friend of mine talking about the possible outlook of the entire market and how this would actually affect everyone's portfolio in the very near future. So let's start by talking about the current interest rates that we actually have at about 5.5% at the moment, and we are expecting a possible raise or a pause to be happening in the next FOMC meeting that is going to be happening on the 13th of December. Okay, so the consensus are basically that it would most likely pause. If anything, the forecast actually shows a raise, but a lot of people are expecting it to be a pause. But right now, the thing is that a lot of people is not talking about the raise anymore. We are actually thinking that we are completely done with the actual increment of rate hike, and now we are going to be going into a cutting cycle. So of course, now we have to explain the cutting cycle because the last time we actually had a cutting cycle was actually during the COVID period, where we had a immediate drop down to 0% interest rates to in order to help to stimulate the market a little bit, which of course that actually generated a lot of inflation because there's a lot of stimulus checks. It helped with a lot of spending, and in return, of course, inflation went up, and because of that, in order to combat those inflationary returns, we have to increase interest rates. So now we have to actually get into a cutting cycle. So previously, a lot of people actually had the average that it takes about 14 months of pausing before we actually see the first cut. So this is a historical average, and we are expecting that to be happening for quite some time. However, for this current cycle, it seems to be slightly different. Okay, a lot of people think that maybe we're not going to be taking 14 months. If anything, we might even take 6 or even 8 months only. So if we are going to be taking a little bit under a year to actually reach a cutting phase, a lot of people are thinking that we might even get it in the early second half of 2024. So getting a rates cut pretty early on basically justifies that the Federal Reserve has completely done their job. It means the job is basically done. Okay, they have finished whatever mandate that they're supposed to do. They're supposed to bring inflation downwards. They are supposed to reach maximum employment. And that's basically saying that the Federal Reserve has already done their job. They don't have to worry about interest rates. Now all they have to do is just cautiously cut rates. Now, of course, this might seem like a lot of words that doesn't really make any sense. So just take this if you will. The stocks market is going to love the cutting phase. Okay, the cutting phase is going to be the best phase because banks and all these different financial institutions are not going to be having high rates for their fixed deposits, cash deposits, all these different financial vehicles that they actually offer to the open market. Similarly, with your corporate bonds, your government bonds, all this different stuff, all this are going to be basically going down in rates as well. So effectively, getting about a 5% money market funds, you're not going to be getting that in the next year. Chances are it's going to be dropping to about 4.2%, 3.8%, whatever it may be. Okay, we're going to be starting to see a decreasing yield on a lot of money market funds, a lot of corporate bonds, a lot of government bonds, things of that nature. So, if that were to be the case, that means that all this money is going to be going into stocks market, or basically other assets. It could be precious metal, it could be commodities, it could be real estate, it could be a lot of different things, okay? But effectively, it's going to be going into appreciating assets, which is why it's going to be a very important time for you to get into appreciating assets. So, appreciating assets, I think I'll make a different video on it. But right now, I'll give you guys the bare bones of it so that you can kind of understand where I'm actually coming from. Okay, so first of all, of course, the stocks market, equity. Okay, equity in good companies, equity in the FANG, equity in tech companies, equity in the Dow Jones, equity in ETFs. It doesn't really matter, okay? Equities in general, chances are we are probably going to see a little bit of an increase in the short term. Of course, do let me put out a disclaimer. Not a financial advisor. I'm not sure. I don't have a crystal ball. I do not know where it's going to be going, okay? This is basically just based on some of the historical data that we have based on a cutting cycle, what actually happens afterwards. Okay, so effectively what we're actually expecting it to happen is in the short term. Okay, the short term, say, meaning about 1 to 2 years, okay? I'm not going to be putting out as like a 4 to 5 years because like I said in a lot of my previous videos, I do see stocks market actually trending sideways. Okay, but anyway, let's talk about this first, which is for the next 1 to 2 years, we are most likely going to be getting a relatively bullish sentiment, I believe, in the whole entire market. I think tech sectors is going to be going up nevertheless, especially if it's going to be paired with good earnings alongside with all these different things. That's going to be helping them a lot as well. Now, the next one, precious metal. I think precious metal, it might be going up, but it's not going to be going up at crazy levels because precious metal usually appreciate a lot faster during high uncertainty period. So, for example, with what happened with the Hamas-Israel conflict, with what happened with the Russia-Ukraine happening, and with a potential China-Taiwan situation, we're not sure just yet. All these different sort of scenarios can actually cause precious metal to actually increase in price. Now we have to talk about commodities. So commodities, similar to precious metal, seeing how precious metal is considered as a commodity as well. For precious metal, for commodities, it's going to be slightly different, although basically all similar, because for commodities you're actually talking about your all your different material. You can be talking about aluminum, you can be talking about wheat, you can be talking about like vibranium, I don't know, man. Like all these different commodities out there are going to be going up in price. Well, they're going to be deviating a little bit. Of course, for commodities that are more commonly found, such as wheat and such, you might want to be slightly more careful with that, simply because we are starting to see a little bit of a deflation happening, especially with the recent producer price index, which is the PPI. It basically tracks the inflation that happens to the producers, the suppliers of such. And we're starting to see actual deflationary numbers coming in, which means that there is a good chance that if deflation is starting to get weighed into all these different reports, some of the commodities might actually be going downwards. So that's the difference that you kind of have to look out for when you're looking at commodities. Now, if you're looking at different assets such as real estate or businesses, angel investing and whatnot, I think similarly, depending on how big your initial investments are going to be, it really depends, simply because if you're getting into real estates, chances are it's going to start to have a little bit more volume in terms of the purchasing and selling, because as interest rates go down, people are more willing to be buying houses. Okay, with more volumes, basically it means that people would be having more transaction, and that usually brings the prices generally upwards. Okay, right now the transaction happening for houses in general, not just in the United States, it's happening all over the world, even in Singapore as well, where if people are not buying houses, people are not selling houses, it means that all these houses are not going to get any transaction. Effectively, prices are going to stay relatively stagnant for houses in general. Okay, so when interest rates start to fall in the next year or two, chances are a lot of people will start to buy houses and they will just refinance whatever mortgage rates that they actually have, and then so on and so forth. And then if you want to go into alternative assets, for example, I'll just take one to prevent this video from going to 20 minutes long. So if we only have one alternative asset that we can talk about, I think we have to talk about cryptocurrency. So for cryptocurrency, I believe that a lot of bulls, especially on Twitter or X, whichever you want to call it, on Twitter, a lot of crypto bulls actually come out to talk about their theses about how next will run. You're going to have this coin go to this level. You're going to see NFT go to this level. You're going to see Bitcoin. You're going to see Ethereum go to this level and such. Fair enough. Again, because like I said, when interest rates starts to go down, you are effectively seeing more of a risk-off environment in the whole entire market, which means that people would be a lot more willing to put money into different bets to see if it goes up or not. Okay, because the thing is that previously in 2023, it's a lot, in 2020 actually, it was a lot more risk on. Okay, and everyone, it's risk off, my bad, vice versa on that. Yeah, it's a lot more risk on. It's a lot more risk off in 2022 simply because people don't want to get into risky stuff, okay? Because my income is going to be limited to what I'm spending on all this high inflationary products that's already in the market that a consumer basically needs. Energy prices, food prices, shelter prices, whatever it is, everything is going up in price. And my wages is not really going up as much. So I have a limited income and an increasing expenditure. So I don't want to be putting money into things that might go to zero. Okay, but right now in 2023 and even 2024, I believe that we're going to be going more into a risk-on environment where we would start to see, maybe I can just put like $10,000 into Bitcoin and see what that actually brings for me. I can put $10,000 into Ethereum and see what that brings for me. And whatever NFT or coins that you wish to put your money into. Now you can actually talk about all these different alternative assets that might bring value, because you would most likely want to go into a riskier portfolio to actually help with the bullish market. So I think that's basically what you can really tell from just an interest rate increase or a decrease, which is why I believe it's so important for me to actually talk about the increase or decrease or the pausing of interest rates. I know that it sounds redundant and it's probably repetitive for me to keep talking about the interest rates as if like it is a mantra of some religion, but I feel that it's pretty important for me to look out for the interest rates to actually see what people are doing. And when you actually see what people are doing, you are able to kind of mimic what you can be doing to maximize the returns on your own investments. But anyway, I thought that would be a quick update on what's happening in the interest rate side of things. We are going to be getting the FOMC, the last meeting of 2023, on the 13th of December. So after that, we basically would see if we are going to be ending the 2023 at 5.5% or 5.75%. But of course, I would also be making a summary video for that because I thought that it would be kind of a nice ending to this whole entire thing, seeing how it's going to be the last meeting of the year. But anyway, that's all I have for this video. Thank you so much for watching, and I'll see you guys in the next one. Peace out. Bye.